Okay, so now we've got to the crisis. Let's go on to the second part of what we want to talk about this evening, which is to say, what are our options? What can we do about this? What should be done? Now, I want, therefore, to talk about a different set of issues. Now, I want to talk about the structure of regulation. And rather, as I've done so far in this talk, I'm going to take another detour, and then I'll bring you back to the financial sector. I want to talk a bit about the history of regulation. And I want not to talk about financial regulation in the first place. I want to talk about airline regulation. Because the story of airline regulation obviously goes back to the early days of aviation. It's pretty obvious that planes and commercial aviation needs to be regulated in some sense. Firstly, it's not very practical for you as a passenger to check that a plane is safe before you get on it. You really want someone to have done that for you before you get to the boarding gate. Secondly, right, even if we didn't care from the point of view of passengers, we really want to be sure that the planes that are flying over central London every day are reasonably well maintained and safe. So we obviously need to have some form of airline regulation. So that was instituted quite early. But people then realized that if you're going to have safe planes, you're much more likely to have safe planes if you have well-run airlines. And if you have well-run airlines, you need to make sure that these airlines are properly capitalized. And if you want to make sure they're properly capitalized, you need to start reviewing their accounting and pricing policies. And if you're going to make sure they're running safe planes, you want to make sure they don't skimp on maintenance expenditure, so you want to make sure they're fairly profitable, and so on, and so on, and so on. And the result of that was that in the airline industry, the scope of regulation, which began by looking at planes, gradually came to extend to almost every part of the airline industry. In the 1970s, there was even a famous debate among airline regulators as to what exactly the meaning of an airline sandwich was, as well as regulating things like how far the seats could be apart and so on. What happened, in effect, was that after 50 years, what had begun as an exercise in monitoring airline safety actually became a cartel being operated by the regulators on behalf of established airlines. And between 1938 and the early 1970s, there was not, for example, a single new entrant into the American airline industry. All that disappeared in the 1970s as a result of a curious coalition of left and right in the US Congress. The left in Congress believed that this had become a racket operated on behalf of large corporations, and the right believed that consumers would be much better served by a proper free market airline policy. And both left and right were absolutely right in thinking these things, as subsequent events would prove. And in the 1980s, deregulation in Europe started to follow. It hasn't quite got there yet, finally, but it's got quite a long part of the way. And the result, as you all know, is that consumers are a good deal better served by cheaper and more frequent airline services than they ever were in the past. And airline regulation now focuses on the principal issues that really are of public concern, which are issues to do with airline safety. What I'm describing here is the process by which regulation of behavior in an industry, as in the airline industry, comes gradually to encompass more and more aspects of the activity of the industry. And the end result of that kind of structure, as you saw in aviation, is to get a regulatory system that is at once very extensive and intrusive, and on the other is ineffective and subject to what is called regulatory capture. And regulatory capture is the process by which the people who regulate an industry come to see the industry they regulate through the eyes of the established firms in the industry itself. And that is what has happened in financial services. Everyone who works in people who work in the financial services, regulators, have experience and knowledge of the financial services industry and not of very much else. Most of them have a background in the financial services industry. Where else could they get the kind of expertise that is needed to do the kind of jobs they do? And who do they talk to every day, and where do they get information about the industry from? The answer is from the people they talk to in the industry. There was a very clever man called Charles Adams who was president of the United Pacific Railroad. And when the first economic regulation in the United States was introduced in the 1880s, he managed to persuade the railroads that they ought to be in favor of regulation and suppressed their instinctive reaction, which was, of course, to resist it. Adams wrote to a friendly congressman describing the kind of bill that he wanted to get through Congress. What is required, he said, is something rather elaborate, having a good sound, but signifying actually very little. And that is what Adams got. And within 20 years, the Interstate Commerce Commission, that was the result of that bill, was, as Adams had hoped, operating essentially a cartel to fix railroad rates, the kind of cartel which the industry had failed to establish itself for the 2 decades that had preceded 1886. This idea of regulatory capture goes back has a long history. Actually, it's not just that we have a regulatory structure in financial services that has been captured in the sense I described. It's also that we have a structure that largely lacks either the technical competence or the political authority actually to do its job. The truth is, being a junior regulator in a financial services agency is not a very good job. It's not even a very well-paid job. And we're talking about the regulators of an industry in which people with very mediocre abilities indeed are paid very large amounts of money. The blunt truth is that people in regulatory agencies, or indeed in government departments dealing with financial services, who are good at their job, are quite quickly hired by the industry at large multiples of their salaries. It's only a couple of weeks since I remember a discussion with someone in the financial services industry who said people in the Treasury dealing with financial services are no good. Of course they're no good. If they were any good, we'd have hired them already. And that's the way all this goes. In other words, we need to be relatively modest and realistic about what financial services regulation can achieve. Everyone is talking about more regulation, better regulation of financial services in the wake of the crisis. Nobody can be against better regulation in the wake of the crisis. Nobody can doubt that more regulation of some sort or another is necessary, but we need to be realistic about what it achieves. And some of the demands for more regulation are from people who are just naive about what it can achieve, and others of it comes from people in the industry who are very far from naive and know that they will get in place, as they are getting in place, measures that, as Adams described, have a good sound but actually signify very little. the truth is that the SEC, which is the most powerful financial services regulatory agency in the world, could not catch Bernie Madoff, a ludicrous crook engaged in a Ponzi scheme, until he turned himself into the FBI. And what we ought to be trying to do is getting agencies that can at least do that. And once they've got good at that, then we can think a bit further about whether they ought to be monitoring the risk management strategies of Goldman Sachs. But pretending they're actually going to do that is just living in a fantasy world. So we ought to think about these issues, I suggest, in a rather different way. And we ought, when we think about regulation, to realize that regulation works better when we focus on regulating structure rather than regulating behavior. What we need is actually fairly simple rules about what people can and can't do that can actually be monitored fairly easily. And that means structural regulation, regulation that aims at the structure of the industry and not at the behavior. Now let me talk about one final area away from financial services. And this is the discussion of what is known as the analysis of normal accidents. It's a term that was invented 30 years ago by an American sociologist called Charles Perrow. What we have in financial services is what we all recognize as a problem of systemic risk. That is, what went wrong in 2007, 2008 wasn't that individual institutions broke down. It was that when individual institutions had problems, that created issues for the system as a whole. Now, there's a lot of work being done over decades on the analysis of failures in complex systems, and typically they're complex engineering systems. They're incidents like the Piper Alpha oil rig disaster, which I just talked about, or the most recent BP oil disaster in the Gulf of Mexico. Things like the Columbia Space Shuttle, 3 Mile Island. And people have devoted a huge amount of effort to understanding why these things go wrong in complex engineering systems, and this is the important point, to designing systems that are as robust as they can be made to the kind of accidents that will inevitably happen. Because inevitably accidents will happen in complex systems, but what you need to do is you need to introduce brakes that enable you to ring fence particular areas that have failed. You need to introduce redundancy into the system so that if some component or group of components fails, another group of components will, at least for a time, take up the slack and the problems which they have created. You need to put emphasis on what is often called loose coupling rather than tight coupling. Tight coupling means that one incident transmits its consequences right through the whole system, whereas loose coupling means there's enough freedom and flexibility in the system that these things can work themselves out without bringing the whole system to a halt, and so on. These issues are ones of system design, not of ensuring infallibility of individual components, because you will never succeed in imposing infallibility of individual components. What all these arguments are pointing to is saying that what we need in order to create a financial system that is more robust to the kind of problems we have seen is one that involves some kind of structural reform. And you can see the nature of the structural reform from the way I was describing issues right at the beginning. What we need to do is go back to a simpler world in which there are fewer inescapable linkages between different parts of the system. One of the striking things about the businesses that failed in 2007, 2008 was that in almost every case, the part which brought the whole operation down was a relatively small part of the total operation of the system. The people who were mainly responsible for the activities at Royal Bank of Scotland that brought about the collapse of one of the world's largest banks, there were less than 1,000 people engaged in these activities out of a total workforce of 170,000. The people who brought about the collapse of the AIG, America's largest insurance company, were a group of people who worked in London in what they called their financial products group. There were 120 of them, and most of the people who worked in AIG didn't even know that that particular division existed or was part of AIG, and so on. You could tell the same story. What we need is to have a simpler structure in which we break down things into their component parts and silos in the ways in which they were before the changes in the 1970s and the 1980s and the creation of these ego-driven financial conglomerates. So that as we break up the financial system into simpler and disconnected units, we can see two things. One is we can have units which individually can fail without doing a great deal of damage to the system, and we can ensure that these individual failures are not transmitted to other institutions in quite disconnected parts of the financial system. We in Britain can't reform the global economy, but what we in Britain can do is protect our domestic economy from these kind of failures or in large measure create that kind of opportunity. What we can do in Britain is to strip out what I've described as the utility elements of the financial system from the casino elements. And in truth, we'll come back to that analogy between casino elements of investment banking and the casinos I was describing in Mayfair a bit earlier. Because the bits we actually need to make our economy go on operating on a day-to-day basis are primarily the payment system, the mortgage and consumer credit market, and the SME, small, medium-sized enterprise lending segment. And if we separate these out from investment banking systems, we can ensure, first of all, that their functioning is not going to be affected or not much affected by failures elsewhere in the financial system. And if they are, it's going to be possible for governments to provide directed funds that will go to keeping these central parts of the system afloat, instead of as we've done in the last few years, government providing extraordinarily large amounts of money to the financial system as a whole without any effective direction over where that money goes. In fact, the way we organise these casinos in London is that we want London to be, as it is, a world centre for the casino industry, but we make it quite hard for British residents to get into these places and play in them. And that, I think, is exactly the strategy we want to employ with the financial services industry. We want, and we can, have London going on being a global centre for these kind of activities, but we want to disconnect it as far as we can from the operation of the UK economy. There's a saying in the illegal drugs business that what distinguishes the pros from the amateurs in this game is that the pros aren't high on their own product. And that's a lesson that I think we ought to apply to financial services as well. Sadly, I don't think this is going to happen, either globally or in Britain. And I think the consequences of that are very serious indeed. I described at the beginning of what I had to say this evening the ways in which we had relatively stable structures of financial services through to the 1970s and 1980s. In fact, although people say that financial crises are an inescapable part of modern economies, actually we went through in the Western world a period from the crises of the late 20s, early 30s to the early 1980s, a period of about 50 years in which there were essentially no financial crises at all, or no major financial crises. Actually, increasingly since then, financial crises have been the major driver of wider economic crises. And in the last 2 decades, we've been through 3 major groups of crises. The Asian and emerging market debt crisis of the mid-90s, the new economy boom and bubble at the turn of the century, and the securitization and credit crisis we've just been through, each of them very different in their obvious, the proximate characteristics, but each of them very similar in the sense that they were caused by a mixture of asset mispricing, herd behavior on the part of people in the financial sector, followed by a correction of that mispricing that imposed large collateral damage elsewhere in the economy, that was then remedied by pumping large amounts of public money into the system in ways that that provided fuel for the next round of crisis. That is essentially what we have done again this time round. And what we can notice going through these past crises is that on each occasion, the amplitude of the crisis has increased. My fear, indeed my expectation, is that what will happen is, when, who knows, perhaps quite quickly, perhaps it will be another 3, 5, 7 years, we will go through a larger crisis than we've yet experienced, in a world in which the last crisis taxed the ability of world governments to deal with the immediate consequences. And that potentially, I think, goes with a political crisis as well, or has a potential for it, because we have what we have today in Britain and the United States is a large amount of justified but essentially unfocused public anger about what has happened that finds no focus, no leadership, no means to articulate itself very effectively. My fear, if we go through another crisis, is that we have a potential for demagogic politicians. We can already see elements of this around in our political structure to capitalize on that kind of public anger. And that means we're faced with a potential for a set of political and economic crises that can be larger than anything we've experienced recently or indeed in my lifetime, and which is really one that is caused by a mixture of rather bad economics and a small number of greedy people. I'll stop there and see if you've thoughts, questions, anything you'd like to throw back at me.